the physical gold has established the uptrend, then eventually the gold stocks follow. So when I say we're in a sweet spot, I really truly think we're in a sweet spot. The condition precedent for the gold stocks to move has already occurred, and the gold stocks haven't moved yet. There is a skepticism in the market because of the tepid response of the gold stocks, which keeps other people from competing with knowledgeable speculators such as myself. This feels to me just like as good as it can possibly get. I need to say that when I talk optimistically, I stick to the proposition that I made the last time you interviewed me, which is to say that if you look at the length and breadth of the junior market, probably 80% of them are valueless. So you can't invest in the sector, but probably 5% of the companies generate so much performance that they add legitimacy and luster to a sector where 80% of the participants are valueless. And it is that 5 to 20% that I'm talking about. When they say that there's no financing available for juniors, that's hokum. Most of the juniors aren't financeable. I have participated, I think, in about 20 financings in the last 24 months. And at least 15 of them were oversubscribed, meaning despite the fact that I'm a fairly high-profile investor, somebody who companies like to have on their roster, I got cut back on my subscription. That doesn't seem to me to be a capital short market. But that notwithstanding, I think there are very, very good companies available for very fair prices, and that's a wonderful circumstance. And I use gold as an illustration, but clearly as an example, the copper thesis that we would have talked about on your show in 2022, had we talked, has played out. We talked about the fact that at $20 a pound, it had to go up to a market clearing price. It had to go up to the price where producers earned their cost of capital. And guess what? It did. We talked about the fact that the COVID-depressed levels of oil and gas pricing had to increase when people began to travel again because the oil industry didn't earn its cost of capital and frankly couldn't pay their taxes at prior prices. Well, it did. And the markets have responded. So, I would say that we're, with regards to mining equities and mining private placement debt, that we're in one of those truly, truly, truly lovely circumstances. I'm not going to say that we won't have a recession. And if we have a recession, that bull market's going to be derailed for 2 or 3 years. I'm not smart enough to tell you that we are or we aren't. I am smart enough, or rather old enough, to tell you that we will come out the backside of a recession. It's odd that at 71 years of age, I have more patience than most of your younger listeners, but experience has given me that. And we will come out of the backside of that recession. I'm also not saying that there isn't some sort of black swan event which could cause a liquidity squeeze, a 2008 style liquidity squeeze, and take all equity markets down 50%. That's something that can happen. It seems to happen every 10 or 15 years, whether we need it or not. What I'm saying is that if you look at the probabilities of all the circumstances in front of us, the probability of supply shortages within 5 years in industrial materials like oil and copper, the probability of higher precious metals prices as a consequence of the deterioration in purchasing power offered up by fiat-denominated savings products, and the fact that equity valuations are measured against commodity prices and historical norms attractive, means that we are in a wonderful circumstance right now as investors. The circumstance which we enjoyed in the first 6 months of this year, anybody who didn't enjoy it wasn't a knowledgeable player, will continue. The gratification which was inevitable is now imminent. And that's just a wonderful circumstance.
Well, about that, I find myself as an investor and somebody who has skin in the game as well as an incredible amount of interest in this. I find myself almost afraid because I'm too optimistic, if that makes sense. Because like you've said, it's a sweet spot. And I'm rarely in a sweet spot, if that makes sense.
It's been a long time since the valuations were reasonable, but the catalysts were in place.
Yes.
I think the fact that you look at this circumstance and you're still cautious means you're likely to make money. There are a lot of people who will draw solace from the fact that on news stocks are going up as opposed to sideways these days and become incautious. If you become incautious in this sector, you become poor
Yeah.
and you do it very rapidly. So I would suggest to people that they remember the admonishment at the beginning of this interview, which was out of a population of 3,000 juniors worldwide, at least 80% are valueless. If you pay a penny a share for them, you're overpaying. That doesn't mean that they won't go up in price. It means that if you juxtapose the price to value, you're exposing yourself to a lot of risk. I would also, Andy, further to that discussion of caution, uh, tell your listeners that one of the things that I've seen is that most people own way too many stocks. As you probably know, I've graded 80,000 investor portfolios over the last 10 years.
Mine included.
I've learned probably more than I've taught. And one of the things I've learned is that many speculators own way too many companies. I have told people in the Rule Classroom that I believe that the number of companies that they should own in their portfolio corresponds exactly to the number of hours per month they plan to work. I think you need to allocate a minimum of 1 hour per company per month. Reading the filing statements, reading the annual report, reading the proxy, not listening to podcasts. That comes under the heading general education, not specific education. So if you can afford or stand or like to spend 10 hours a month, then you can own 10 juniors. If you can afford 20 hours per month, then you can afford 20 juniors. But I see portfolios where people who have lives, they have kids, they have jobs, they have stuff like that, and they have 65 or 70 companies in their portfolio. It's impossible that they can follow that many companies.
Hmm. Yeah, that's great advice. Especially you got to do the work. You got to just, like anything, you just really have to do the work, put in the effort. Um, we talked about last time we talked a lot about silver. We've always talked about gold. We've talked some about uranium. What I want to know now is what are you seeing that's as a commodity class, asset class? What do you see that you're interested in and is possibly undervalued or underinvested in right now? Going, going on right now.
Two things. Tier one projects that are juniors, which is to say projects that have the hallmarks of having a minimum of $10 billion in situ recoverable reserves that would be in the bottom cost quartile worldwide and the top quartile in terms of return on capital employed, but at least 25%. If those projects aren't in glamour materials, they are stupidly cheap, really, truly stupidly cheap. There are projects that look like they could develop into generational assets that are trading at below 20% of indicated NAV. These are projects that, if the drilling continues as it has happened so far, will be sold to major mining companies. And they will be sold to major mining companies for 10-figure sums. The fact that the exploration process, the delineation process, the PFS process is boring means that people have sold off these high quality assets in favor of frankly shitty assets that have more near-term momentum. There's nothing in the world that makes me happier than this, by the way. The fact that I can fill my boots for long periods of time with very little competition around assets that seemingly to me have absolutely no downside except perhaps political risk and tenfold upside. So I really like that theme. The other thing I like is grassroots exploration with high quality teams, really high quality teams.